On Christmas Day, 2002, a man named Jack Whitaker drove to a Super 8 motel in West Virginia to buy a biscuit, and for reasons he couldn't explain, he bought a lottery ticket. He won $315 million, the largest single jackpot in history at the time. Jack wasn't a desperate man. He was already a construction CEO worth millions. He knew how to handle cash. He told the press, "I just want to work and live my life." But the money didn't let him. Within 4 years, Jack was broke. His daughter was dead. His granddaughter was dead. He had been sued 400 times, robbed repeatedly, and left by his wife. We look at Jack and we sneer. We tell ourselves that he was a fool, a statistical anomaly, and that if we had that money, we would be disciplined. We would buy the index funds. We would be safe.
That is the single most dangerous lie you tell yourself. Jack isn't the exception. Jack is the mirror. We are raised to believe that finance is physics, a hard science ruled by laws, spreadsheets, and interest rates. We think if we can just learn the math, we can master the game. But money isn't physics. In physics, if a bridge collapses, the other bridges don't panic and sell their support beams. Money is biology. It is psychology. It is a soft skill masquerading as a hard science. And unless you understand the 12 glitches in your brain that dictate how you behave, the math will not save you. You are not a rational economic actor. You are a biological machine wired for survival on the savannah, trying to navigate a global economy that doesn't care if you live or die.
The first glitch is a hallucination called the man in the car paradox. You see a sleek black Ferrari roar down the street. It's loud, it's aggressive, and your eyes lock onto it. Your brain immediately starts a fantasy. If I had that car, people would think I'm successful. They would think I'm important. But here is the irony that you miss every single time. You don't give a damn about the driver. You don't know who he is, and you don't care. You are using his car to fantasize about yourself. This is the trap. You think you are buying respect, but you are actually just buying a prop for other people's daydreams. No one is impressed by your possessions as much as you are. You are bankrupting yourself to buy admiration from people who aren't looking at you. They are looking at your stuff and imagining themselves holding it. This leads to the uncomfortable truth that wealth is exactly what you do not see. We are visual creatures. We judge survival by what is visible. In the wild, a large animal is powerful. In capitalism, a large house is successful. But rich and wealthy are two different things. Rich is a high current income. It's the cash flowing in that allows you to make the monthly payment on the Porsche. It is flashy, loud, and fragile. Wealth is the income not spent. Wealth is the option to buy something later. It is the factory, not the product. It is hidden. But because we cannot see wealth, we cannot emulate it. We emulate rich because it's the only data point we have. We try to copy the spending habits of people who are secretly drowning in debt, assuming they have figured out the game, when in reality, they are just bleeding out slower than everyone else. Once you start spending to match that illusion, you trigger the Diderot effect. Denis Diderot was an 18th century French philosopher who lived in poverty until he suddenly came into a fortune. He bought a beautiful scarlet robe. But then he noticed his rug looked cheap compared to the robe, so he replaced the rug. Then his chair looked ragged, so he replaced the chair. He spiraled into debt, replacing perfectly functional things, just to match the identity of his new purchase. You have felt this. You buy the new phone, and suddenly your headphones feel old. You buy the house, and now the furniture isn't good enough. You aren't buying things for their utility. You are buying them to maintain a coherent narrative about who you are. And that narrative is an endless, hungry void that will eat your future to feed your ego. The system is designed to exploit these glitches through relativity. Your brain has no internal price tag for value. You don't know what a house or a car is actually worth. You only know what it costs compared to the thing next to it. If I show you a bottle of wine for $100 and then one for $25, the $25 bottle feels like a bargain, even if it's overpriced swill. This is anchoring. You don't evaluate the price of a stock or a home based on its fundamentals. You evaluate it based on the price it was yesterday. If your neighbor asks for $1 million for his house, suddenly $900,000 feels like a steal. You are making six-figure decisions based on optical illusions. You are being manipulated by contrast, not guided by logic.
And when that logic fails, the pain sets in.
This is loss aversion. If you find $100 on the sidewalk, your brain gives you a little hit of dopamine. It's nice. But if you lose $100 from your wallet, you feel a visceral pit in your stomach. The pain of losing is evolutionary. It is twice as powerful as the pleasure of gaining. This is why you panic sell. When the market drops 10%, the pain is physical. You aren't selling to save your money, you are selling to stop the pain. You are prioritizing immediate emotional relief over long-term financial survival. You are not managing a portfolio, you are managing your own anxiety. Even if you win, even if you make the money, you are running on the hedonic treadmill. You tell yourself, if I just got a 50% raise, my life would be perfect. So you get the raise, and for 3 months it feels great. But then you adopt. The luxury car becomes just the car. The fancy dinner becomes just dinner. Your expectations rise in lockstep with your income. The goalpost moves. This is why you see investment bankers earning $500,000 a year who feel like they are barely scraping by. They aren't lying. They have simply adjusted their baseline of happiness to match their baseline of spending. They are running faster and faster, sweating and stressing, but they are standing perfectly still. The reason we can't break out of this is that the human brain is built for linear thinking, but money moves exponentially. If you hunt 1 deer, you eat for a week. 2 deer, 2 weeks. 1 + 1 = 2. But compound interest is not linear, and we are physically incapable of comprehending it. If I gave you a choice between $3 million cash today or a single penny that doubles every day for 31 days, your gut screams to take the $3 million. But if you take the penny, by day 30 you have $5.3 million. By day 31, you have $10.7 million. All the growth happens at the very end, in a sudden, violent explosion of value. Warren Buffett is worth $84 billion, but $81 billion of that came after his 65th birthday. We ignore small savings because they seem pointless in the moment. We interrupt the compounding because we get bored. We treat money like a sprint, but it is a marathon, where the only lap that counts is the one you run when you're 80. Because the math is exponential, the risks are asymmetrical. This requires a concept engineers call margin of safety, but in finance, we just call it room for error. You must plan on your plan not going according to plan. The most important part of your strategy isn't how much you make when you're right, it's how much you survive when you're wrong. Cash is a terrible investment. It loses value to inflation every year. But functionally, cash is the oxygen that keeps you alive when the underwater currents drag you down. If you are 100% efficient, every dollar invested, heavily leveraged, you have no margin for error. One bad month, one job loss, and the compounding stops. You interrupt the curve. The goal isn't to get the highest return. The goal is to survive long enough for the compounding to actually work. But surviving is hard because of the seduction of pessimism. Optimism sounds like a sales pitch. It sounds like I'm trying to sell you a course. But pessimism sounds smart. It sounds intellectual. If someone tells you the economy is about to collapse, you listen. You feel like they are trying to save you. Evolutionarily, we are wired to react to threats. The bush that rustles might be a tiger. If you ignore the tiger, you die. If you ignore the berry bush, you just miss lunch. So we pay 10 times more attention to bad news. But history proves that while markets crash quickly and violently, they grow slowly and silently. Pessimism creates the headlines, but optimism creates the wealth. The people who sound the smartest are often the ones who stay poor. So why are we doing this? What is the actual utility of the money? It is not about buying stuff. Money is about buying control. The highest dividend money pays is the ability to wake up in the morning and say, I can do whatever the hell I want today. Angus Campbell, a psychologist who studied happiness for decades, found that the strongest common denominator for happiness wasn't income, geography, or education. It was having control over your time. If you are earning $1 million a year, but you are checking emails at 2 a.m. and your boss owns your schedule, you are not wealthy. You are a well-paid indentured servant. You have simply built a golden cage and handed someone else the key. To get that control, you have to stop playing someone else's game. We look at a stock soaring and think, I should buy that. But who is driving that price? Maybe it's a day trader trying to make a quick buck before lunch. Maybe it's a pension fund looking for a 30-year hold. If you are a long-term investor and you take cues from a day trader, you will lose.
Prices that look rational to them are insane to you. You are running a marathon, looking at the pace of a sprinter, and wondering why you feel slow. You must know what game you are playing and completely ignore the scoreboards of the games being played around you. Finally, you must learn the hardest lesson of all, the definition of enough. There is no number. If you think the number is $1 million, you will hit it, and you will immediately look at the person with $5 million. Capitalism is great at two things: generating wealth and generating envy. It is designed to make you feel incomplete. There is a story about the authors Kurt Vonnegut and Joseph Heller. They were at a party hosted by a billionaire hedge fund manager. Vonnegut asks Heller, "How does it feel to know that our host made more money yesterday than your book Catch-22 has made in its entire history?" And Heller replies, "I have something he will never have." Vonnegut asks, "What could that possibly be?" And Heller says, "Enough." The spreadsheet is easy. Spend less than you earn. Invest the difference. Wait, the math is 4th grade level, but the psychology is a master's degree in discipline. You have to be willing to look like an idiot in the short term to look like a genius in the long term. You have to save like a pessimist, but invest like an optimist. You have to realize that the person driving the Ferrari is probably insecure, not successful. Money is a tool. It is a magnifying glass. If you are a kind person, money makes you a philanthropist. If you are an anxious person, money makes you paranoid. If you are a fool, money makes you a tragedy. So before you look at your portfolio, look at yourself. Because the most dangerous risk to your financial future isn't the inflation rate, and it isn't the stock market crash. It's you.